Happy Thursday. Excited to dive in with you with another weekly webinar. Today, we're going to talk about passive investing, where it makes sense, why, if you are currently looking at investments, why passive investing, specifically in multifamily, is definitely a space you want to look into. And furthermore, ultimately, the difference between the active and the passive side of an investment. So why become a passive investor? We hear a lot of different reasons. Notably, in some capacity, typically you are either into maybe crypto or stocks or something else where you're exposed into a certain space and maybe you're looking to diversify. And real estate can be a great portfolio diversified investment because it offers you the opportunity to invest into a real asset. One of the major benefits with multifamily is there's a lot of different levers that can be pulled that can help you with the investment at hand. Multifamily investment can offer cash flow. Basically, as the rent is paid by your tenants, it's not only covering the operating expenses and also paying the debt down, but it's providing cash flow past that it can be dispersed out to the members. There's the potential for appreciation. There's market appreciation, meaning inherent from just the market appreciating itself, but also the one that we specifically focused on, forced appreciation. That's where we do a targeted renovation package to go in there and improve the property with the intention to ultimately improve the operations, which improves the revenue and again creates more cash flow. Past that, there is the tax advantages that is offered by owning real estate and potential to do a cost segregation study or to take advantage of depreciation. We use a financial engineering study called cost segregation, which basically is an engineered study that accelerates the depreciation, allows us to take losses in an accelerated manner that are basically paper losses that are passed through K1s for investors onto the property. And lastly will be debt pay down. As your property is being improved, run efficiently with the rent that's coming in, we're also paying down the debt onto the property. So one of the things that have been so attractive about the multifamily space is there's not one specific way that you can win. There's multiple ways. And we find investors in their own right look for a number of things or one in particular to why they want to invest. As mentioned, some do want to look for portfolio diversification. Some want to look to basically get cash flow from a passive investment that can go out there and help either as an ancillary income to what they're already making currently in their job, or to be an income replacer so they can get more time back. And basically for that the income or the passive investments, basically the cash flow coming off there can help cover their expenses. One of the great things as a passive investor is you are not actively managing the deal. You're investing with an operator who is going out there to source the deal, to create the relationships, to find the deal, to put together the debt for the property along with the equity and run the deal. And your point as a passive investor is truly just that, passive. You're going to now invest capital into the project. That capital itself is going to cover the down payment, going to cover the renovations, any of the closing costs and fees associated with the property, alongside the capital that the general partners put in as well. And in return, there is a structure that's broken out of how the returns will come back to that investor. Typically for us, we offer a preferred return, meaning that first out of the cash flow is going to go to the passive investors before the operators. And that first out of cash flow is going to reach a certain rate before there's any split of additional cash flow that now includes the operators or the managing members. So for instance, if you invest $100,000, we may offer a 7% preferred return, meaning that each year $7,000 of returns will be distributed to a member who has invested $100,000 before there would be any split that would go to the general partners along with the members past that. So typical structure you could see out there would be a 7% preferred return. After that, there may be a 70-30 split, meaning 70% of additional revenue or additional cash flow past the 7% will still go to the members, and the remaining 30% will now go to the operating partners. So it'd be a very viable opportunity for you to look at when to invest in real estate. One of the great things is that we've all seen what's happened potentially right in crypto space right now, or even with stocks like Netflix, where you can see just a huge swing in the value just due to market noise or things that are happening in market conditions. Well, you buy with real estate, it's a fixed asset. And the longevity of investing in real estate overall has traditionally proved to be very beneficial. On a 10-year hold, the average return on multifamily investments is between 11 and 12% overall. So the long-term hold for properties can be very valuable, especially when not only are you taking advantage of the cash flow, but you're also looking at the appreciation that comes into play, the depreciation tax advantages that also are warranted for the investment. So the few different metrics that we look at, and typically you'll see on a lot of deals, are cash on cash return, average annual return, IRR, and we'll say MOIC, or multiple on invested capital. The cash on cash return is simply with your investment, what is your return each year on that money, not including the profit from the sale. So that would be your cash and cash return. Your average annual return would be just that, the average of the return over the years of the deal, including the potential profit from the sale. So that's where the average annual return will come in. It makes it different than the cash on cash. It's just now making sense of what is actually including the profit into the average of those returns. Next is the IRR, the internal rate of return. That simply is just the return of cash flows. So it's the return on the stream of cash flows, meaning that it would be more valuable for you to have $1 in your hand today than it would a year into the future. So that's going to be predicated based on the return of cash flows. And that's that rate right there, the internal rate of return. And lastly, the MOIC or multiplier is simply if you invest $1, how much will you get back overall completion, including the return of that $1 through the full cycle of the project, from acquisition through the cash flows through the sale. So typically for our projects, we're targeting over a 5-year horizon, anywhere between a 1.7 to 2x multiple, meaning that if you had invested $100,000, the intention is that we are building into our models to be able to return, including that $100,000, $170,000 to $200,000. So pretty simple on that of how we break that out. So those are a lot of the metrics, those 4 metrics right there, is that typically what you'll see in a lot of offerings out there. Now, a few pieces of the puzzle here is that once a deal is being presented, you're typically going to see that whether the investor has a portal or they just email out the offering, you're going to see an investment summary. The investment summary itself is typically going to explain the deal, explain the breakout of the deal from unit type to the current rents, to the comp set of rent comps and sales comps, to the market, basically the market it's in, whether it's in a large MSA, breaking it down to the city and or sub-market. Then it's going to speak to the team. Who is the team? Who are the members of the deal here? One of my team has just walked in, one of my little guys right here. So on that front, that will be some of the plays of this, is that looking forward, ultimately, what will be some of the piece of the puzzle to expect. It will be a deal package that will basically break out the deal itself, and the unit mix, the returns, and also the unit breakdown, the market itself. Where is the investment? Why is this market such a strong market? What do we like about the market? Why do we invest in this market? Have we invested in this market before? And who will be the team? And that can be both our internal and our external team. Who is going to manage this property? Will it be the property manager, or will we self-manage? Who will be the operating partners? Will it be just our team here at Yarusi Holdings, or will it be our team and other general partners as well? So these will be some of the very important talking points that you'll see in regards to the investment summary. Okay, so that's some of the main pieces of the puzzle that you can expect and why you look at passive investments here.
I was still off it.
That's okay. But in that front, one of the main goals is to make sure that you look at the investment, see how it can be beneficial to you, how it can be a viable resource for you, and why it can be one of the main advantages to add to your investment portfolio. Of course, if you'd like to hear more about us, we have a lot of great marketing going out there right now. You can go and find us at yarusiholdings.com. You can also see anything about our current offerings, deals we worked in the past, including case studies. Thank you. And then on that front, we can go in there and dive in to do other points of having a conversation with you. You can learn more about us, our philosophy, the type of offerings we've worked on, and go and have a listen to our podcast, Multifamily Live podcast. We've done a lot of talk points in the past. We've covered a lot of these things. We've had some great guests talking about all things related to multifamily. And again, go over to yarusiholdings.com. We're always working on offerings. We'd love to learn more about you and your story, what you've invested in the past, what you are looking for your investments in the future here, to better understand how we can potentially be a benefit to you going forward. Thank you so much.